Good afternoon from Oanda, Asia Pacific. I'm Jeff Halley. Well, here we are at the start of a new month and indeed a new quarter. And we've seen stock markets in Asia rally today, and we've seen some moves in the currency markets as well. I would say to viewers, be a little careful of markets bearing gifts today, because we do get a lot of quarter end and month end rebalancing flows rushing through various asset markets on this particular day, and it can actually create some false impressions in the market. However, one thing that won't create a false impression will be this week's data highlight, which is the US non-farm payrolls this Friday. Now, there's been a lot of talk about the US recovery, post-pandemic, yada, yada, yada. And there's been a lot of talk about 1 million plus jobs added per month going to happen, etc., etc. But it's not happened. When we look at the non-farm payroll chart over the last few months, we can see 500,000, an 800,000, a 300,000, a 550,000, no 1 million jobs added. Now, this is actually giving the markets a bit of a quandary, because they're torn between transitory and sticky inflation. Which one is it? And it's very hard to say when the data itself is becoming quite ambiguous. And this is what the non-farm payrolls has most certainly been. But if we look at the US dollar index, now this is a chart that has been catching my eye for a little while now. And since the FOMC dot plot surprise a couple of weeks ago, well, the US dollar, despite so many pundits saying that it should be moving lower because bond rates are moving lower and stocks are moving up, it's actually held on to most of its gains. And this says to me that currency markets are perhaps a little bit more concerned about upside surprises in US data, upside surprises therefore in inflation, then perhaps equity markets and clearly the US bond market are. This says to me that the direction of least resistance this Friday will be a higher US dollar. Now, what would happen? What would cause that? Probably a large non-farm payrolls print at long last. We're expecting about 700,000 jobs, but if it comes out around 900 to 1 million, we could easily see the dollar index spike. Now we can see on the chart that it has held support quite beautifully at its 200-day moving average around 91.50, and it is looking poised for bigger gains. That would feed across through to weakness in the major currencies and most likely emerging markets. And when we look at euro versus the US dollar, we can see that it is hovering around support at 118.50. Now, a move through 118 could set off a much deeper correction, because as we can see from this chart, it actually broke out of its uptrend from 122 quite some time ago. Sterling is also vulnerable to a deeper correction, as are Kiwi and Aussie, which are also barometers of market sentiment. And that sentiment hasn't been great this week, and that's mostly because of this Delta variant of COVID-19, and in particular, its impact on various Southeast Asian nations, and that has very much weighed on sentiment out in this part of the world. Another asset class that I believe is quite vulnerable this Friday is gold. Now, if we look at gold, we can see that it is hovering around quite important support at $1,760. It is very much moving inversely to the US dollar at the moment, and the US dollar strengthened overnight and gold fell $17, and it is struggling to recover. Now, a daily close underneath that support level, let's call it $1,755 an ounce to give it some breathing room from a technical perspective, does set up a potentially much deeper correction. My line in the sand is the bottom blue line that you can see on the chart, 1,680. And if we break that level, then I would actually be calling the gold rally as completed, and we're going to have to go back and think about things again. So it's all about the non-farm payrolls on Friday. All roads lead in that direction. Thanks very much for listening in, and I wish you a profitable trading week ahead. Thank you.